Welcome to Breaking Down Barrier Income. Breaking Down Barrier Income is a monthly series featuring Simplify's Barrier Income ETF, ticker symbol SBAR. SBAR launched mid-April 2025, and SBAR is redefining the income-focused structured product landscape by transforming a traditional structured note experience into an innovative ETF solution. My name is Jeff Schwarty, Chief Equity Strategist at Simplify. Joining me today is Sid Sethi, Lead Portfolio Manager for SBAR. Welcome, Sid.
Thank you.
In today's video, I will reviewing performance, realized distribution yields, operational benefits, and use cases for SBAR. I will then turn over the discussion to Sid to provide valuable insights into the current positioning of SBAR in the barrier option market. Let's jump into the discussion. So as of 9/30/2025, SBAR has had a realized annualized distribution rate of 12.88%. Our expectations of ongoing realized yields would be closer to 9 to 11% over a full market cycle. The SEC yield is just under 4%, driven entirely by the Treasury positions within the portfolio. Since launch, SBAR has posted a just over 10% total return with a just under 12% annualized realized volatility. Since mid-April, equity markets have done fairly well, and SBAR continues to have a pretty good return profile of consistent returns driven by the equity indices that support the strategy. As far as the use cases are concerned for SBAR, we really see three use cases for investors. Investors seeking high monthly income, as I mentioned before, just under or just a 12.8% distribution rate with just under 4% SEC yield. So getting that nice distribution on a monthly basis. Also, investors seek an alternative to equities. So as we all know, equities can have some volatile episodes, and we're able to mitigate some of that equity volatility using a barrier option set at 30%. Every barrier option within SBAR will have a 30% barrier, which basically means at the end of the term structure, if the reference indices have broken the barrier, the fund would participate in that drawdown. And lastly, investors looking for an alternative to bonds. Again, we're creating income. There's limited duration exposure in the form of treasuries, no counterparty risk, and no credit risk because we're not buying individual bonds. Sid, what are your thoughts on this particular slide of investors seeking different outcomes?
Jeff, so this is the crux of the usage of SBAR and succinctly put into three different outcomes. I think the high monthly income one is self-explanatory, so we'll not touch that. The other two, which is equity alternative and alternative to bonds, are important ones, specifically now when we've seen sort of bonds falter and equities reach all-time highs. So most of our clients do think of SBAR as a combination of the second and third options, where they have this strategic allocation to equities plus bonds, and they can sort of take away some allocations from both of them and allocate that to SBAR, which does sort of help them create these monthly coupons in the high double digits, in the low double digits, in the high single digits, low double digits. One important thing to note here is more specifically, if you're looking for SBAR as an equity alternative, it really depends on your view of equity market. So if you believe that there's, you want to chase, massive capital appreciation, or you believe there is very high upside to equity markets, then potentially SBAR is not the product for you. Then you would be better off being in equity underlyings or equity instruments. While if you believe that there is limited upside, which would be somewhere below, the target yield range, which, as you discussed before, Jeff, it's roughly 9 to 11%. If you believe that the equity upside is limited, and you might be more defensive in the sense that you believe that there might be more downside than upside, then SBAR could be a good alternative, because in periods where market is not doing anything, or anything above minus 30% return would make you would make SBAR a better alternative to equities.
Yeah, said another way, Sid, if you expect returns for equities to be, say, 12% or lower, SBAR would be a really good solution for investors.
Exactly.
And the total return is going to be driven by income. treasuries as well as the premium from selling the barrier options. As far as those that have used structured notes in the past, I think the operational burden has been lifted with SBAR. We do all the monitoring of the rolling of the individual positions if they get called. And for investors that haven't used structured notes, it's a very efficient way to get exposure to the outcomes that SBAR is promoting. It's within the 40s Act fund, just like any other ETF. Fees are a bit lower than structured notes, and you get full transparency in holdings and pricing and distribution. So continuous liquidity, no lockups, which is a very, very valuable feature from what our clients tell us. They're looking for continuous liquidity. So again, if you haven't used structured notes or you have used structured notes, I think SBAR would make your life a bit easier from an operational perspective. Now let's get a little bit deeper into the specific positionings of the portfolio, Sid. The next slide really highlights two reasons why we're enhancing the potential earnings of SBAR. The first one is callability. So after a specific time period, if the reference indices are above the initial value, that allows the position to be called, and then we can take those annualized premiums and we can return stack them. It's called auto callability. So we're constantly monitoring positions when their observations dates are, and if they've increased in value, that's where we can enhance the yield potentially. And then really the worst of, so we're looking at a swap exposure that looks at three different underlying indices. We've got S&P, Russell 2000, and NASDAQ. So the S&P 500, NASDAQ, Russell 2000, we look at the worst performing of those three indices at the end of the period. If any one of those has broken the barrier on expiration, that's the only day that matters is at expiration, then the fund would participate in that drawdown. But we're diversifying the exposures to minimize path dependency risk. The next slide, Sid, is extremely important. I think it's probably the best slide in the deck. So I'll ask you to kind of clear the deck and show the slide to folks and explain what we're seeing here.
Absolutely. So, I mean, before we do that, I mean, I just want to highlight one point. SBAR, the motivation behind SBAR was to provide a liquid alternative to autocallables, which are income products, typically offered through structured notes, which, by by the format that they are offered in, which is notes, are typically illiquid and do have a lockup period. So, offering this instrument, which was typically in an illiquid format, with an evergreen sort of exposure, which is through weekly stacked expiries or weekly stacked autocallabilities, as we want to call it, helps us generate, SBAR exposure in a liquid instrument like ETF. And so what we're going to dive into is going to show you how SBAR in itself is structured. So let's dive in.
Mm-hmm.
If you look at the chart at the top, let's look at the x-axis. So the x-axis basically gives you the percentage of each position as a notional of the portfolio. So what this means is currently, let's say we have 34 positions in the portfolio, the x-axis labeled gives you what is the notional percentage of that position as a percentage of the total SBAR portfolio. Taking an example, if you look at the first one on the very left, it's 10.1%. So if SBAR, let's assume, has $100 million notional, then 10.1% would mean that the notional exposure of that particular note that was struck is 10.1 million. So that's the x-axis. Now let's switch to the y-axis. The y-axis basically gives you the distance to the barrier. So
Mm-hmm.
for each of these 34, separately struck autocallables, each of them, because of the way the market moves, each of them has a different worst off barrier versus the current spot. And what we're trying to do is to sort of give you an idea or a pictorial representation of all these 34 autocallables versus how they are stacked, based on their strike date. Now, let's switch our focus to the first one, which is the 10.1%. The 10.1% notional autocallable. If you see there's a line next to it, which goes from roughly 35% to 37%. Now, what this represents is currently in our autocallable universe, we are using a worst of three underlyings, which is S&P, NASDAQ, and Russell. So the bottom point of this line, which is roughly 35%, represents the worst performing underlying and its distance to the barrier. So what it's saying is your worst underlying is 35% away from the barrier. If this particular underlying was below 35% at maturity, only then this option would become active or become live, which is when you are short the put. Similarly, the topmost point represents the best performing asset. So the best performing asset is roughly 37% away from the barrier. So at maturity, it has to be down more than 37% for the put to become active. Now, the distance between the two, which is 37 minus 35, it's 2% roughly, is the dispersion between the three assets that we currently have in the portfolio. So this line gives you a good idea of what is the range of performance of the three different underlyings versus the strike date on that particular autocallable. So hopefully that is clear, and then we'll move on to some of the key stats, which is just below the chart. So the first stat is the number of positions. So as we mentioned, there's around 34 autocallables as of the date that we've looked at this portfolio, which is 12th of October, 2025. Then the next one is average distance to the barrier. So this is calculated as 30.5%. This distance is an average of the position. So it's not a notional average, it's just a regular average. And it's taking the average of the worst performing asset. So going back to the chart, if you look at the bottom point of each of the specific positions in the portfolio, it's just the average of each of those bottom points. That is roughly 30.5%. Then the next one is percentage eligible for autocall, which is 63%. Now, this simply represents how many of these autocalls out of 34, how many of them are above the initial spot on strike date. So essentially, for each of them, we see, okay, on date T when they were struck, on trade date, what was the spot, and are they currently above the spot that they were struck at, all three of the underlyings. And the percentage of them that are above will be called as soon as they hit the autocallability date or autocallability minimum. And the rest of them would not be able to hit because they are below the spot or below the autocallability level. So that's roughly 63%. And then the last two are something that Jeff already described before, the distribution rate, which is analyzed at 12.88%, and the SEC yield, which is roughly 4%, driven more by the Treasury securities.
Yeah, so maybe to summarize, Sid, I think the x-axis is really important for our investors to understand that we have laddered the positions where each position typically is going to expire on a Friday,
Yep.
1 year in the future. The positions on the left-hand side are the oldest, the positions on the right side are the newest. And so you can see diversification. You can see that there's a significant, on average, barrier threshold. You've got to drop more than 30% for the entire portfolio to break the barrier. So we could have positions that break the barrier. I think historically, Sid, I did a study where I looked at the last 3 years, 35 years of looking at the worst of those indices we mentioned, S&P, NASDAQ, Russell, on a rolling 1 year basis, on a weekly basis, rolling 1 year weekly maturities. We only broke the barrier about 10% of the time. So 90% of the time, these three worst of indices do not break the barrier, and that particular position would not experience that drawdown. So I think the probabilities are on investors' side if you think in terms of that distance to correct is pretty significant. Global financial crisis was where the majority of the breaking of the barriers occurred historically. So we put this on our website every Sunday evening as of Friday's positioning. So take a look at that if you have questions. But we use this a lot with clients to understand the strategy and where things sit in a real-time basis. So let's pivot a little bit more to your day job, which is looking at volatility correlations and the barrier option market. What are you seeing from a volatility perspective in the market?
Yeah. Before that, I just want to quickly touch on the performance of SBAR and what has happened up till now since the middle of April when we first launched SBAR and XV. So coming in from April, we were coming in from a tariff tantrum, which meant that the walls or implied walls were quite high, and there was a market drawdown that was ensued post the Liberation Day. And coming from this period, of course, high volatility, which is what we are selling. And so, volatility being high and juicy means that what we are selling has a higher premium. So going into, a bullish market where S&P has rallied 20+%, that provided a good tailwind to the SBAR portfolio. While high volatility was an important driving factor, specifically in April, the rally that we saw in S&P became more important as things progressed. Coming back to your old slide where the two major features which we are using to add return is one of them is autocallability. The autocallability played a major role because essentially, given the continuous rally in S&P, we were able to strike our options again and again and again, which basically mean that the overall return that we've generated in SBAR is higher than what we would have ultimately generated if we had just struck a vanilla 12-month option as of 14th of April. So that's a strong point and sort of highlights the effectiveness of the return enhancers that these autocallables use. Now, coming back to the chart that you see on the screen, and kind of paints a similar picture. We see very high walls back in April. Of course, there was the walls faded post that point as things got more clearer. But we are seeing a little bit of a bullish trend in walls, more specifically in September and October. And I wanted to touch a little bit on that. And so basically, if the walls remain float or they are afloat and they are higher, it is of course a good sign for the product because it means that you are getting paid a good premium to hold the risk that we are taking, which is a contingency to a 30% downside. So the higher walls are better for the product. It helps us generate a higher return and ultimately receive more premiums from the counterparties that we are trading these autocallables with. Now, there are certain drivers of this volatility being higher, and I wanted to quickly touch on them. I think we have seen that markets have been rallying a lot since April, and this means that people who are invested in the equity markets are starting to buy protection, given that they've sort of already realized a lot of those gains, given that they do expect a reversal in the market. So that has caused sort of an increase in the skew or the walls on the downside, which is put buying on S&P, NASDAQ, and Russell, which could be one of the driving factors that we see for the walls being more float. The second one, as we, again, given the market rally, we have seen more call buying, which in turn also adds to the wall pickup because ultimately, the whole wall surface gets, bid up because of the returns or because of the buying of these long wall instruments. The third one, and we are monitoring that for another product that we have at Simplify, which is SWAL. We are looking at VIX-based ETPs, and overall, when we look at the positioning of VIX ETPs across the whole universe, we see that typically right now they are positioned as long Vega, which means that investors are in general defensive, which again means that there's a bid for vol, which causes the vols to be higher. The last one, which is more related to structured products, and I think is slightly more important, is what has been happening is, we saw this magnificent rally in equities. So as a person who's invested in structured products, you would typically sell a knock-in put, and as the market rallies at a certain point, you get knocked out, which means that the product gets called and the risk is removed. Now, if you think about this exposure from the broker-dealer side, what they are doing is essentially they are selling the put for you, and in the event that the product gets called, they eventually have to de-risk their portfolio, which means that they have to buy back some of the puts that they've sold, ultimately bidding up the vols in these 70 to 80% out of the money regions, specifically on the longer tenors. So that has also caused this bid up for vols. Again, all of these factors are basically telling us that we are getting a good risk premium for the ultimate contingent downside risk that we are taking, and is sort of bullish for remaining in the portfolio going forward.
Yeah. So for investors that aren't monitoring vol regimes every day, increased vols mean increased premiums, right? And if rates normalize, the treasury yield will likely go down, but you could still have pretty attractive yields if the vol surface remains elevated, given all the headlines that everybody's reading. So let's pivot real quick, Sid, to the correlations and how that impacts how we think about SBAR.
Absolutely. And again, I would highlight back to the 2 points. How are we enhancing the returns of autocallables? I think the another one of the features that you mentioned was worst off. So just for everyone's sakes, I mean, the way worst off or the way correlation impacts the premium is the lower the correlation between the underlyings, the higher the premium, which means that let's say if we had S&P and VIX, and S&P and VIX, as we know, are typically negatively correlated. If you had both of them in our portfolio, because of the negative correlation, we are almost sure that at least one of them will go down. This would cause the premium to increase because we are just playing for the worst of underlying. So similar to that, if your correlation decreases, then your premium should typically increase.
Yep.
Now correlation behaves in a certain way based on the market environment. So if there's a risk-off environment, which means the walls are high, which is what we saw back in April, everything becomes more correlated, and this is sort of a well-known fact. There's a risk averseness. Everything gets very, very correlated. Correlation goes to 1, and walls get high. But as things sort of subside and it turns more risk on, and market has been rallying for some time, every underlying sort of behaves in its own way, and the correlation sort of decrease over time. So the proportional, contribution of worst off as an increase in the income stream gets higher. So that's what we are seeing in the chart here. If you see like April environments, I mean the correlations were close to 1, and now we are seeing those pairwise correlations sort of dip below, and those are adding to the income stream. So that is also sort of a positive factor in the premiums that we are receiving through autocallables. And I just want to highlight what you're seeing on the screen is like rolling 3-month pairwise correlation. So, for each of the pairs that we have, so
Mhm.
S&P Nasdaq, S&P Russell, and Nasdaq Russell, we are sort of plotting the 3-month pairwise correlations.
Yep. So again, high drivers of high income from SBAR will be treasuries, which we have a slide in a second. We've got low correlations, increase that premium, and then just the vol surface in general, headlines, moving equity markets are all additive to a potential income stream. Maybe we'll hit this last slide, Sid, and we'll open up to other questions. But impact of easing rates or normalizing rates, what will that impact have on SBAR's distribution yield expectation?
Well, tying it back to SBAR and its yield, I think typically the yield that you see at SBAR, the top level yield that you see, is subdivided into 2 parts. One of that is option income or option premium, which is what we've talked about before, and then the other last part is it's rates, treasuries, or bond income. And of course, because they both are, as a combination, reflect the top line SBAR yield, we do expect that as rates decline, you should have some, lowering of the overall SBAR yield. Now, let's take a step back and see what we are targeting. I think what we were looking at before, and Jeff, you mentioned it, was like, roughly the target is about 9 to 11%.
Mhm.
Currently, what we are analyzing is roughly around 13%, versus like a 4% yield from treasuries. So the option income would be roughly around 9% or so. And even if you assume that, we would be, down by like 50 bips or so from the treasury income, that is still well within the yield target that we have for the portfolio. So I think that's something that I definitely want to highlight.
Okay. Thank you, Sid. Maybe a couple more questions before we close, Sid. Can you kind of give our viewers, if you look at the holdings, sometimes you'll see non-calls 1 month, non-calls 4 months. I think that's the band that I've seen since launch. What will help you just decide between the non-call period? What gives you that decision point?
Absolutely. I think let me just talk about the intuition first, and then we'll dig in. I think
Okay.
if you look at an option, let's say you are selling an option which has a 1-year maturity. Let's say the premium is 100. If you're selling an option with a callability feature where it can be called at any point during the life of the option because of certain factors, arguably the premium that you receive for the option should be lower. So in terms of how much you're getting paid for a 1-year option, you would, let's say, get paid 100. For a 1-year option with a 3-month non-callability period, you would, let's say, get paid 80. For a 1-year option with a 1-month non-callability, maybe you get paid 70. So
Okay.
that's how premiums would work. Now, coming back to the point, now the way that we are looking at callability is, in its original sense, we are trying to use it to enhance our income.
Mm.
If you look at risk-off environments, you look at GFC, you look at COVID, you look at the tariff tantrum, what you'll see is a lot of the uncertainty is priced at the very front end. What I mean by that is the volatility that you see for shorter tenors, which is like, let's say, 1 week, 1 month, 3 month, that increases a lot more than the back end, which is, let's say, 12-month, 1 year, 2 year, 3 years. And so what it causes is the term structure of volatility, which basically means that if you just had to plot a wall for every expiry on the S&P or the NASDAQ or the Russell maturities, you would see that there's a curve. Typically, it's upward sloping, which means that the longer the maturity, the higher the wall. But in these periods, it sort of gets reversed where the shorter maturity has a higher wall than the longer maturities.
Mm-hmm.
Now, to take benefit from this inversion of vol term structure, what we do is we are trying to go for more shorter term non-callabilities like NC1. Now, as you can imagine, because NC1 should be priced lower than NC3, which is the 3-month non-callability, and vol term structure is elevated, the front end walls are higher, the difference between NC1 and NC3 gets smaller.
Gotcha.
So this gives us a benefit where we can play for the rebound or buying the dip, as you want to call it, and play for the same optionality again the next month and again the next month after that. While if we had to do a 3-month, we'd have to wait for at least 3 months for it to reinitiate the trade. So in periods with higher vol, with market has already corrected, we are sort of shifting more to shorter non-callable periods. Of course, taking advantage of the higher short-term vols. While in periods where market has rallied, things are stable, vols are of course lower, we typically go for longer non-callability periods like NC3. So like July, August, we shifted more to NC3, where the vols were lower, so we are trying to lock in a higher premium. Which so that we are not betting on market being up the next month, but market definitely being up in the next 3 months and getting paid for that uncertainty. So that's how we sort of seesaw between NC1 and NC3. I mean, I would definitely note that even this recent drawdown that we had like a week or two ago, we did buy some NC1s where we were trying to sort of buy the dip within our SBAR portfolio.
Yeah, I think what you've highlighted, Sid, to me is that this is not a rules-based framework. It's full active management at its finest, where you're similar to like the VIX futures curve or the yield curve. You're looking at that term structure of barrier income and trying to find the sweet spot to maximize the yield from selling barrier options as well as like protecting the portfolio. So thank you for those insights. Again, SBAR seeks high monthly income, helps mitigate equity risk with a 30% barrier, and provides investors with a diverse source of income. Would also want to highlight it's got continuous liquidity, unlike some other strategies such as annuities in the marketplace. As I mentioned before, this is a monthly series where Sid and I will be highlighting SBAR as well as other insights from the barrier option market. Sid, thank you so much for participating. And yep.
Before we go, I just wanted to highlight we have added a hedge position in our portfolio, which I definitely wanted to highlight. I think and maybe share a little bit of the reasoning behind that. If you look at auto-callable products and particularly the one that we are using, which is contingent downside, the risk to the portfolio is a bigger move in equity markets where the markets are down more than 10, 20, 25, 30%, and that's when you hit the barrier and start realizing the losses where the put essentially becomes active. And so it's less of a correction risk where the market is down 5, 10, 15%, but more of a bigger drawdown risk or the colloquial term, as you all want to call it, tail risk. Right. So we have added a hedge position, which in premium is very small, roughly like 25 to 30 pips of the overall portfolio, which is roughly 20% out of the money, so roughly 80% strike, which sort of helps us position better in those scenarios, specifically now as we are at all-time highs in all 3 underlyings. Again, the idea here is buy something which is cheap, as vols are cheap. Buy something a little bit more out of the money, and ultimately protect from the higher beta that would typically happen once you reach that 20% point.
Yep. So 34 barrier options that were short, treasuries, long, and then a long put option for extra protection as the valuations were extremely affordable to put that position in the portfolio. Sid, thank you for your time. We'll see you next month, where we'll provide additional insights into SBAR. Thank you for your time and have a great day.